Hi, everybody. This is Drew Armstrong. I am your host of Post-Hoc Live. Thank you for joining us. I'm also the executive editor here of Endpoints News. Today, we are going to talk about market structure. Now, before you open your mouth to yawn, let me argue that this is actually really important and has a huge impact on how biotech stocks trade. Specifically, we're going to get into the S&P Biotech Index, better known as the XBI, which is one of the most closely watched measures of how the industry is faring. We've got just the person to do that as our guest today. Cantor Fitzgerald's Josh Schimmer has a great note out a few weeks ago titled "The XBI may be finally poised to deliver," in which he unpacks what's going on in the index, some of its history, and how good-seeming things like M&A can actually distort the perception of how the industry is doing when viewed through the XBI. Now, before Josh joins us, I've got just a little bit of housekeeping. First of all, if you're joining us for the first time, hello. Post-Hoc Live brings you the reporting, the analysis, the debate. It usually happens behind the scenes in our newsroom, live to you. If you're joining us on YouTube and you're not already following us, please hit the subscribe button below our feed to get alerts about future live streams. You can also sign up for our Post-Hoc email on your Endpoints News subscription page. For those of you joining us on YouTube, you can use the live chat to join the conversation and ask us questions. If you miss us live, recordings will live on YouTube and Spotify, as well as Apple Podcasts. Josh, welcome to the show. Thank you for being with us. So you've got this great note out a few weeks ago. I read it beginning to end. I sent you an email about it as soon as I saw it. Will you talk to me a little bit about, one, why you decided to write, this particular analysis in this particular moment where the XBI has just kind of been stuck, it feels like, for, maybe running several years now? Like, what was the impetus behind taking a look at this? And maybe tell us a little bit about what you did and why you did it.
Sure. Well, first of all, thanks for having me. Big fan of yours and a big fan of Endpoint News in general. Just absolutely indispensable source of information for us and most of us in the industry.
Thank you.
Yeah, I think the answer was kind of in the question, right? Why do this in the first place? It wasn't that I wrote the note. I just kind of wanted to look at what was going on with the XBI. It hasn't really gone anywhere for around 8 years. So there was a little blip around COVID, but it's been a significant struggle. I think many of us look at it as a proxy of a generalist investor enthusiasm for biotech. And there are plenty of reasons to think that generalist investors may not find biotech investing particularly appealing. It's very binary, it's very volatile. Even some of the most expert biotech dedicated or life science dedicated investors often struggle to deliver meaningful performance on a year-to-year basis. So, from that lens, one can understand why it might not be the most attractive sector for generalist investors who don't have that much time or resources or energy to allocate to a very complex sector. But on the other hand, I wanted to speculate, well, what could make biotech more appealing? And one thing that we have seen over the last, say, 2 to 3 years or so is a number of companies that have really made that transition from pre-commercial to commercial quite successfully. We're seeing a number of very good product launches. We're seeing companies now transitioning to profitability, which used to be what every biotech company would do anything to avoid. But I think they're starting to recognize that profitability can be a good thing. So the outlook for biotech in general looks like it's potentially improving, and potentially as a sector improving enough for generalists to start paying more attention and perhaps start getting more comfortable with the sector selectively, right? And maybe perhaps feeling more comfortable in revenue generating and earning generating companies, especially as those valuations start to look more appealing and compelling. Now the XBI itself is a tricky beast. I don't pretend to be an expert on the XBI. It's this modified equal weighting, rebalanced every quarter, modified for trading volume. So that introduces some distortional effects for the index itself. That index is a security, right? So I don't cover the XBI. I cover certain companies in biotech that I'm actually very enthusiastic for it, but I think many of us are starting to notice this trend, this maturation of the biotech industry, in part because the IPO window's been
Been
closed for some
shut.
time now.
Yeah.
And so we haven't, flooded the landscape with more immature companies. And the ones that are still there, have had a number of years now to survive and thrive or to not, right? And the
Right.
ones that don't thrive, which there are always going to be many because that's the nature of the industry. It is, it's a very binary, risky industry, but one that when things work can provide tremendous value to patients and as such investors. But as those companies do fail, they also kind of drift away, right? They don't get included in indices. They kind of fall off radar screens for investors. And so what we're left with, what we're watching on a day-to-day basis becomes a very exciting ecosystem with less risk than it's historically had. Again, because the sector's matured and with tremendous growth outlook.
Yeah. Do you think, I mean, when we think about what the XBI is, and I'm trying to remember the exact number of companies, around 150, I think, right?
120 or so.
Yeah. It's like, do you feel like it represents what biotech is? And I think, like, and I ask that, I realize it's a big philosophical, expansive question, but like, I think,
Right.
if you thought about, what is a biotech, like if you wanted an index that measured the health of the biotech industry, there's so many different ways to conceive of what should be on that. Like, should it be big companies like Gilead that are really more like pharma companies, but that,
Yeah.
maybe historically, and in an outdated way have been called a biotech, even though they make a lot of pills. Should it be teeny tiny startups that, have gone public recently and are, their most likely outcome is either to get sold or go out of business? Should it be something in between? Like, as you mentioned, these companies that are kind of moving towards profitability, but maybe one product companies or something like that. And, they've gone from being binary on clinical risk to kind of quarter over quarter performance around one product, which could be, like, I guess, this is a question I feel like I've been debating for 20 years. Like, what is biotech and how should we think about it? And is the XBI as
Mhm.
it is the right way of measuring that? Or are there other better, more precise ways, depending what you wanted to look at, that would be a better measurement of how the industry is doing?
And again, I think the answer is again in your question, right? It depends what you're looking for and what you're looking to derive from the biotech index. Obviously, the XBI has certain limitations. I'd actually say that right. Well, within those limitations, you point out there's some large pharma in there. There are even like med tech and diagnostic companies that kind of wonder what they're doing in a generally drug development type basket. 'Cause I think that's what many of us view the XBI as, reflecting the biotech drug development sector. But I think for the most part, like those probably get evened out. They're just small. Those are small numbers relative to the north of 120 companies in that sector. Personally, I think the biggest disconnect between the XBI and the way that I look at the biotech sector more broadly is that to get into that quote elite group, you have to have had a certain amount of success along the way to get there
Mhm.
in terms of, well, certainly in terms of valuation, but that probably also reflects the company's development efforts. And so the XBI tends to miss those big gaps up, right? From small or
Right.
even potentially micro cap stock into the valuation range that can get you into the XBI. And that's where the XBI starts,
Yeah.
right? So you miss that big move. And when we kind of compare, I've got a tracker of nearly any biotech company I can identify, say north of like 50 million market cap. And when I compare that to the XBI, on a weighted basis, I don't rebalance, etc. Kind of have to accept some limitations to the analysis. I see the large group that includes those smaller names consistently outperforming the XBI to a fairly meaningful degree. And the other point to all this, by the way, is that for the vast majority of us who look at the biotech sector, we're not owning the biotech sector, or we're not recommending investments around the bio, like buy the biotech sector, sell the that's not how it works, right? We look at north of 400 companies, and we're
Right.
trying to find those specific names that we think offer the best risk reward, or depending on the rating and the perspective, the opposite of it. And so by some lenses, the best type of climate for biotech investing for that is more of a flat tape, right? Because we're trying to find those names that are going to go up, right? And we're trying to minimize some of the broad sector noise. And broad sector noise happens when, large pools of money, perhaps generalist money, moves in or moves out. And all of a sudden, your ability to pick individual stocks within this sector can be more challenging because of those macro type issues. And again,
Yeah.
so it's a fascinating discussion. I think from a practical basis, the XBI serves the purpose of being a bit of a proxy for the sector appeal to generalist
Yeah.
investors, and
And
a
I,
loose proxy at that. And again, like we spend most of our time talking about individual stocks.
mhm, mhm.
Sometimes we'll talk about the bigger picture, but we rarely talk about the XBI as though it's something you invest in.
Right. Well, I mean, it's an interesting, and I've heard the argument that, exactly kind of as you're making that like a better measure, if you wanted to be more precise about this, is like, yeah, picking out all the biotechs on the Russell or something like that. And like, really capturing everything. And like it is, in some ways, like exactly to your point, like it's in some ways a flawed, inherently flawed device because why would you buy a index made entirely of stocks that are going to be driven by binary events like that feels like it's not like you're buying oil and gas companies where you could say, oh, hey, like I think that the economy is going to do this and therefore
Right.
oil and gas will do this and it'll be good for it. You're it's having
Right.
a lot of chips on the roulette table. And I can understand how that's long-term reflective, either optimism or pessimism in the industry. But I think it probably makes it very hard on a shorter or even a medium-term basis. And you brought up, I mean, I think to that, you actually brought up this other really interesting point that I really wanted to ask you about, which I thought was, I've seen sort of argued over, which is that, you know, M&A has this counterintuitive effect on the index. Like we all think about, everybody in that works in biotech or watches biotech or invests in bio, M&A is a great thing. It's great for the industry. It means that, companies are, have hopefully been successful and are appealing enough to get bought out at some higher multiple. Obviously, there's these lower value takeouts and things like that. But like it would intuitively seem like a really great thing and a sign of at least some measure of health for the industry. If new companies are getting formed, acquired by, large pharma companies, investors are getting their money back, they're putting that back into new startups and, the cycle repeats. Like this has been kind of the way the industry has worked for, years and years and years and years and years. But counterintuitively, it's actually probably not great in terms of delivering value directly back to the XBI. You made that point. Do you want to explain that a little bit more?
Yeah. Well, first of all,
First of all, am I representing
yeah,
that
right,
correctly? But
right,
yeah.
right. Look, I mean, even the idea that M&A may not be an amazing thing for the biotech industry generates pretty powerful and visceral responses. I can hear the eyes rolling already, even at the idea that maybe M&A is not always the best thing for biotech, and especially as we think about some of these indices that favor those companies that have been around longer and have had success and have had and are on strong top and bottom line growth trajectories. And the more of those you have, the more attractive a sector is going to be at, right? Obviously, with valuation in mind. And so, when some of the best and most promising companies with just tremendous long-term prospects get acquired, and we all cheer and celebrate for that lucky company management team and their investors who walk away with whatever 50, 100% or more premium from the day the stock was trading. but we've also removed that exciting company from the index, right? And we do that quite often. Um, and with an index that is limited to 120 names, right? Like granted, the effect of everyone gets diluted, but if you can get a critical mass of growth type companies within that cluster, and again, it is particularly the XBI index, it selects for success, right? And so the more successes we have, the more they'll be contributing to that index in particular. The other aspect that I think is interesting to talk about is how the industry is kind of uh, it's every company says that they're built to last, they're built to be bought, not sold. But
Yeah.
we know the vast majority of companies want to be acquired by pharma. When they're started at the level of the VC, often, it's typically with an eye of, well, there's an exit opportunity as an IPO, or we'll just sell it to pharma, and always this attuned perspective to what does pharma want to buy and how can we give it to them, right? The problem though is that as much as the industry kind of denies that in many ways that's its reason for being, in many cases, it is. And as an example, you see plenty of companies that are formed and IPO'd and are really driven by a single asset.
Right.
That's not a sustainable biotech company for the
No.
most part, unless you're lucky enough to have a forever asset, which very few biopharma companies have. That's step one to becoming a long-term, sustainable, diversified organization. But just getting one product approved and commercialized successfully is hard enough. And then the idea of having to do it again and again is increasingly daunting. But that's what we do. Like we create a lot of like one trick wonders in the hopes of selling those companies to pharma. My point of the rambling is that we're not creating companies that are really built to
Yeah.
last.
And I want to get into it. Keep going, but I want to talk about this
Right. So
with
if,
you.
if you
Yeah.
if you took M&A off the table in the company formation and investment process, and you kind of ask companies to basically justify not just their short-term existence off of one product cycle, but what their long-term strategy is going to be for value creation, it would be very different approach. We'd most likely be developing sustainable enterprises, sustainable growth companies, companies that, perhaps have a differentiated platform, perhaps have, enough different assets to start to build, a revenue base that is large enough to give them additional opportunities down the road, right? Like if like we went through this era of many years with many companies that were commercial stage selling 200 to 300 million dollars worth of revenue, funding their SG&A, funding a small amount of R&D, and there's no sustainability to
Right.
that,
And
right?
we've seen that. Yeah, we've seen that. Like we did our launch and we killed our pipeline move by
Yeah.
companies. I mean, like Bluebird is the first thing that comes to mind where like as soon as they got close to it, they had to kill off all of the cool stuff that they were working on to try and become commercial stage company. And like and they didn't ever really achieve escape velocity, got sold to private equity, I believe here. And, it's like, yeah, I mean, it's a very short list of big new biotech companies that we've created. I mean, I guess you can count like Alnylam is obviously a standout success, Moderna, but it feels like this is something that comes along just every maybe few years
Every
where
few
we
years,
really
right?
really build something big.
And by the way, when those larger companies that really are representing what biotech can deliver to the world of patients and investors as well, but you often see these companies achieve great success. They might have a little stumble, and then they're acquired. And they
Yeah.
don't have that chance to kind of regrow and get their traction again. Celgene, Alexion, Baxalta, Allergan, right? Genzyme going all the way back to Chiron, right? And so you kind of wonder what our world might look like and whether it would be more, again, like what's the point of all this is to make it more investable to generalist investors who value things such as earnings, earnings per share and things like that. And we have a great way of just, kind of clearing the field of those very promising companies by selling to pharma. And again, so it's the instant gratification that comes
Yeah.
from the company sale.
Hmm.
But you could argue that there's an industry cost because we do it so much. We also create an industry that is one of its goals and raison d'etre is to be pharma's pipeline.
Right.
Not its own pipeline, not its own sustainable enterprise, sustainable type companies that can thrive for not just years but decades. And but I think what's also exciting right now is that the industry, as it evolves, as it matures, I think is starting to um, develop these kind of companies. Now, the big question is, are they going to be standalone companies for years and years and years to come with strong growth prospects and contributing to indices and contributing to profitability of the sector and eventually perhaps them being consolidators as well? There's a lot that biotech gets right that pharma struggles with, one of which being just the efficiency of innovation. Right. And so in here is this nucleus of development power that if given the time and the opportunity, and I think even with pharma M&A is kind of brain draining a little bit or quality draining from the sector, there are enough of these great companies that I think biotech is going to look very, very different in 3 to 5 years than it does now.
You mentioned, the companies on the index in particular that are, poised for EPS growth. Basically, like companies that at the start of the conversation, you meant, the worst thing you can do is, say, oh my gosh, we're heading towards profitability. Making money is the worst thing. And I'm reminded of the iconic HBO Silicon Valley show when the venture capitalist tells the young company, like, God, no, don't project profits. It's the worst thing you could do.
Right.
Great episode. Watch it if you haven't. I'm wondering in that context where you're starting to see companies that have, been able to be commercial or have the possibility of being commercial, does the constraint right now we have of the IPO window having been shut, despite the rest of the market like going through the roof right now, um, you know, do you think that pressure or constraint maybe forces some companies to make the choice to try and sustain this on their own? Or do you see more of these companies kind of hanging on and saying, hey, like we'll kick this along for a couple of quarters until we're able to get bought? I'm just wondering if this period, of several years now without a ton of IPO activity pushes us towards a different kind of strategy or trajectory in the industry, because that's not or because we're not seeing as much M&A, because we're not seeing these exits, and we start to see companies try to figure out how we have to either figure out how to go this alone, do more mergers of equals and try to build things that look different, or like is everybody kind of just kicking this along and waiting until M&A kicks back in and IPOs kick back in and we kind of see the return to the traditional exiter or mature path that we've seen.
Yeah, a couple of I guess thoughts in there and related to the IPO window and the M&A window. The M&A is actually, fairly healthy, certainly this year. We haven't necessarily seen the mega deals, but we've seen a lot of cleanup deals and we have seen some good size deals. So I think for the most part, though, when companies say they get bought, not sold, that is true. Like you can't anticipate M&A, you can't run your company as though M&A is going to happen, even though it might have been initially formed with the hope and the aspiration of someday being acquired. On a day-to-day basis. You have to execute and you have to operate. And perhaps there's been some learnings from the field, recognizing and perhaps some of it is the learnings plus the times that we're in. Companies that undertake highly speculative R&D just almost for the goal of not being profitable. I think investors have become frustrated with that type of approach. It's squandering value. Why would you deploy precious capital on low quality R&D? Just give it back to investors and they'll
Hmm.
find
Hmm.
something better to do with it. So I think over the years that that reckoning has occurred, combined with the fact that valuations are a little bit different than they used to be. You don't get valued on hopes and dreams. You don't get valued on revenue as one used to. Increasingly you're valued on earnings potential. And so the kind of the confluence of those two forces, I think, is what is driving companies to profitability. I think investors just got so tired of seeing low quality R&D uh, with substantial spend on that low quality, and they'd just rather have cash in their, return to shareholders to redeploy.
So I want to ask you a little bit of a historical question here. I mean, like if we look at the period, let's say from like 2010, when the index was trading like around like 15 to 20 bucks, and then there's this incredible run up through 2015, where it goes into the mid 80s. I mean, you see essentially like a 4x return. And I know there was a lot else going on in the broader markets there. We're in the ZERP era and we were kind of post financial crisis run up. But like we've seen, it felt like this, like incredible gain in value. It's this strong, steady kind of growth as well. Like it looks a lot more like other indices that I think, look like longer term looks at the US stock market in general, where like stocks go up over the long term. And then we end up in this weird post 2015 period of, I guess 2015 kicks off the drug pricing conversation. I mean, I remember being at JPM, I think it was in that January where Trump, and Clinton were saying stuff like this. And then, the COVID era, obviously, and then this weird dead period. But what was special about that 2010 to 2015? I mean, were there unique aspects of what was going on in the industry or how generalists were thinking about the industry in that period that drove that level of growth in the index? Like when you think back 15 years, was there something kind of special and unique? It doesn't I mean, I can't remember it being necessarily like a truly, like such a period of flourishing science or, R&D work that people were really rethinking what was possible here. What was going on then? I mean, what was, or in comparison to now? I ask that because like I hear about all the cool stuff happening in biotech and it seems like there's enormous promise. Yes, there are headwinds and so on and so forth, but like it doesn't feel like that. Yeah, I don't know, this period doesn't feel that different, at least on a fundamental level when we talk about the science from then.
Well, I mean, I can barely remember what happened last week, let alone 15 years ago. But I mean, if you want to go back that far, what I would say is that it really was before we ran into substantial price headwinds. Right, and you would see it with price increases across the board as 10, 15% plus and multiple times a year. That's a great way to drive index performance without much risk. Just raise your price, and as long as there's no pushback, and I remember the companies doing that fairly consistently. It was a much smaller industry back then. It was much less competitive as well. That's a really important factor now, right? Like we have oftentimes multiple, if not dozens of companies pursuing a similar target or a similar platform. And when you do that, you create a very, very, very different sector. Um, Risk appetite likely evolved along the way as well with kind of this wave of new IPOs. And so maybe a little bit of a bubbling of the sector before we kind of had to start dealing with consolidation of PBMs and legislations designed to curtail drug spend, right? At some point, drug spend kind of got sizable enough to generate the attention of policymakers and companies to start pushing back. And I think that probably explains much of kind of the evolution that we've been seeing.
Well,
Right. And you even see it in the vulnerability of the sector today.
mhm,
Right.
mhm.
Anytime drug pricing comes up as a consideration, MFN, IRA, like it takes its toll certainly on sentiment, and then over time on fundamentals as well.
Well, I will be very curious to have you back in a year. We've had some prescient notes about what's gonna happen here, and we'll see if this one is spot on. Josh, thank you very much for joining us. You guys were hosting a fantastic conference last week. For those who haven't checked it out, they also had a great note out about the a panel they had on the China question that's going on right now. I would recommend reading that if you get a chance to. So. Josh, thank you so much for joining us. We had a huge audience on X or Twitter today as well. So hello to all the great folks over there. That is unfortunately all the time that we have. Thank you very much for joining us. You can keep up with our coverage on endpoints.news or by subscribing to our newsletters. The recording of this conversation will live on YouTube as well as Spotify and Apple Podcasts later today. If you are already signed up for our Post-Hoc newsletter, you'll get notifications when we have a new broadcast coming up. If you're not signed up, head over to endpoints.news. Top right-hand corner, hit that reader profile link, then preferences, and click to activate Post-Hoc. If you're watching us on YouTube, please hit that little like and subscribe button. You can also follow us on X, LinkedIn, YouTube, Spotify, and Apple Podcasts, and Blue Sky by searching Endpoints News. A huge thank you to our producer and engineer today, Dalen Turk. We will see you the next time news breaks. I'm Drew Armstrong, the host of Post-Hoc Live. Thank you.